Warahmatullahi wabarakatuh. Perkenalkan. Assalamualaikum warahmatullahi wabarakatuh. Introduce myself. My name is Melvin Abdullah Namirullah. My NPM is 224111025 from Management 2022A class. Today I want a presentation about financial statements analysis. Definition: financial statement. Financial statement analysis is the process of evaluating and interpreting a company's financial statements, which include the balance sheet, income statement, and cash flow statement. The purpose of financial statement analysis is to understand a company's financial performance, identify trends, measure financial health, and make informed decision based on the data documented in the financial statement. Here are some important aspects of financial statement analysis. Balance sheet. The balance sheet presents a picture of company's financial position at a point in time. It including assets, what the companies own, liabilities, what the company has to pay, and equity, the difference between asset and liabilities. Balance sheet analysis helps in the liquidity, solvency, and capital structure of the company. Income statement. The income statement reveals the financial performance of the company during a specific period. It includes revenue, expenses, net income, and other component of profit and loss. Income statement analysis helps in understanding the company's profitability, revenue trend, and costs that can be optimized. And then cash flow statement. The cash flow statement lists the cash inflows and outflow of the company over a given period. It helps in providing cash on the company's ability to meet payment obligation. And then financial ratios. Financial statement analysis often involves the calculating and evaluation of financial ratios such as profitability ratios such as ROA or ROE, liquidity ratios such as quick ratio, cash ratio, and debt ratios such as debt to equity ratio. These ratio help in the deeper understanding of the company's financial performance. Comparison and trend. Comparing a company's financial statement from the multiple periods or with competitor in the industry can provide insight into changing trend and company performance that help in determining whether the company is growing, stagnating, or declining. Vertical and horizontal analysis. Vertical analysis involves comparing each item in the financial statement to total asset or revenue, while horizontal analysis involves comparing financial statement item from period to period. The second method helps reveal change and alteration in the company's financial structure and performance. Financial projection. Financial statement analysis can also be used as a basis for making financial projection that will help the company plan for the future and making strategic decisions. Financial statement analysis is an important tool for a manager, investor, creditors, and other and other interested parties to understand a company's financial health and performance, and to make informed decisions based on accurate financial information. The purpose. The purpose of analyzing financial statement it is to gain a better understanding of a company's financial performance and position. By analyzing financial statement, various parties, such as company managers, investors, creditors, financial analysts, and regulators, can achieve several key objectives, including financial performance evaluation, understanding the extent to which a company is achieving its financial and profitability objective. This involves assessing whether the company is generating profit on and optimizing the use of financial resources. Identifying trends in a financial performance over time. This help is this help in determining whether the company is growing, stagnating, or declining. Liquidity and solvency measurement. Analyze, analyze the balance sheet to assess the, the availability of liquidity in the form of cash, and solvency, in the company's ability to meet financial obligation, and then risk and payability assessment. Using the cash flow statement to assess liquidity risk and the company's ability to pay obligation as they come due, and then capital structure assessment. Analyze a company's capital composition and structure, including debt and equity levels, to measure financial risk and use of leverage. Earnings quality assessment. Analyze the income statement to understanding the source of revenue, cost, and other component of profit. This help is assessing the quality of the company's earning. Benchmarking. Comparing a company's financial performance with competitor in the industry to determine the company's relative position in the market. Decision support provides company managers, investors, and creditors with the necessary information to make strategic decisions such as investment, lending, or corporate policy. Legal and regulatory disclosure. Confirm that the company complies with all legal and regulatory requirements related to financial reporting. And then evaluation of management effectiveness. Analyzes the extent to which the company's management is managing financial resources and achieving the financial objectives that have been set. Explanation of various financial ratio. Financial ratio are important tool in financial analysis. Reports used to measure the performance and financial health of a company. Various financial ratios provide insight into certain aspects of a company's performance. Below, I will explain some commonly used type of financial ratio. And then liquidity ratio, current ratio. This ratio measure of company's ability to meet short-term obligation with current assets. The formula is current assets, current liabilities. The higher the current ratio, the more liquid the company is. Quick ratio. This ratio is similar to the current ratio, but ignores inventory as it cannot always be quickly converted into cash. The formula is current asset inventories, current liabilities. Profitability ratio. return on equity, or ROE. This ratio measures how efficient the company is at generating net income for shareholders' equity. The formula is net income or total equity. Return on asset, or ROA. This ratio measures how efficient the company is in generating net income from total asset. The formula is net income or total assets. Gross profit margin. This ratio measures the company's gross profit percentage of revenue. The formula is profit or gross revenue x 100. Debt ratio. Debt to equity ratio. This ratio measures the company's level of debt compared to shareholders' equity. The formula is total debt or total equity. Debt to total capital ratio. This ratio measures the company's debt and equity. The company's debt and equity levels compare to its total capital. The formula is total debt, total equity. Activity ratio. Receivable turnovers, account receivable turnover. This ratio measures how quickly the company collect receivable from the customer. The formula is revenue or average revenue or average receivables. Inventory turnover. This ratio measures how quickly the company sells or utilizes inventory. The formula is cost of goods sold or average inventory. Market ratio, price to earning or PE ratio. This ratio measures the market value of a company's stock compared to its earnings per share. The formula is stock price, earnings per share or EPS. Price to book or PB ratio. This ratio measures to market value of company's stock compared to the book value to the book value of this equity. The formula is stock price or book value per share. And the conclusion. In conclusion, financial research are an important tool in financial statement analysis that provide insight into various aspects of a company's financial performance and health. Financial ratios are used by various parties, including managers, investors, creditors, and financial analysts, to understand and assess a company's liquidity and ability to meet short-term obligations, the profitability of the company, the extent to which the company generates the net the company's debt level and how much leverage it uses in its capital. Efficiency is managing assets and inventory. The performance of the company shares in the stock market, and financial ratios are used to compare a company's performance with competitors in the industry and also with the company's historical data. Financial ratio analysis provides valuable insight in decision making and strategic planning. Thank you. Sekian dari saya. Saya mohon maaf bila ada kesalahan kata atau kesalahan pengejaan dalam bahasa atau kesalahan pronounce dalam bahasa Inggris saya. Saya mohon dimaklumi. Wassalamualaikum warahmatullahi wabarakatuh.